So we've now had the 9th consecutive interest rate increase from the Bank of England. They met today on the 15th of December to announce the increase of 0.5 percentage points. So this means the current rate is 3.5%. So say this is the 9th consecutive increase, but that's actually over the last 12 months because these meetings are every 6 weeks. Where we were a year ago in mid-December of 2021 was 0.1%. So that is an absolutely phenomenal increase, a massive increase over the last year. And that obviously has consequences. I would take you through what it means for your savings, for your mortgages, for your borrowing, things like that, what you might need to do. Before we do that, as I always do in these monthly updates, every 6 week updates, just take you through a little bit more about why that decision was made from the minutes of the Bank of England so you don't have to look at them yourself. So fundamentally, what's happened? This increase, there are 9 people who are on the Bank of England Monetary Policy Committee, 9 people, and they have a vote, and the majority is what wins. So we had on this one, 6 of them wanting this 0.5 percentage point increase. That's the majority, that's what went through. But the other 3 voted quite differently, and that's quite interesting. It might help us think about what happens next. One person wanted an even higher increase. They wanted another 0.75 percentage point increase, the same as we had in November, which was the record single increase. They were like, let's do it now. Let's do more increases. The other 2 wanted to keep it as it was. They wanted no change at all. And that's quite unusual compared to like big increases from, the most people, from 7 of them, either 0.5 percentage point or 0.75 percentage point. And 2 people want to keep it where it was. And that sometimes can be sort of seen as an indication of what might happen in the future, but also quite handily in these minutes, the Bank of England also give a kind of an indication of what they think is going to happen too, based on some surveys they do and markets and all this kind of stuff. So they think that there will be further increases next year in 2023. And they think those increases are going to be between 4.25 percentage points total, like total rates to become that, or 4.75% total base interest rate. To happen, at some point, probably likely towards the middle of next year to reach that highest one. So we might see some gradual increases to get there. We might see nothing happening for a while. And then a big one, who knows? But that's looking where it's going towards in the middle of next year. And then likely to stay at that higher rate, let's say 4.5% for the rest of 2023. So this increase has happened right now, has an immediate impact I'll get through to, but there will be more increases. Very, very likely there will be more increases happening. But this is very, very different. 4.5%. If you watched my updates previously, particularly the one the last couple of months, you'll know they were talking about potentially going to 5.5% or 6% or maybe above 6% in the middle of 2023. That has been reined back massively. And that has an impact, as I spoke about in my recent savings update. And I'll talk about it again in a minute on fixed rate savings. And also it has an impact on fixed rate mortgages as well. Really, really sort of reduce this kind of prediction of where things can go. Now, with these things, the interest rate, base rate of interest from the Bank of England, these predictions change on a regular basis. So just because they're saying this in the minutes now where they think it's going to go next year, could change completely. Something could happen. Don't imagine we'll have another mini budget that kind of makes everything go topsy-turvy. But something could happen worldwide, domestically, who knows, where they think, right, we want to increase it faster and higher. Or it could be that we talked about those 2 people in this current decision-making process saying they want to stick where it is. Well, they're doing that for a reason. They're thinking maybe the rates already gone up as high as they need to. We can slow things down. And if they are able to, if they prove correct over the coming months, maybe we won't see those larger increases. Maybe we won't see many at all. But fundamentally, I think we should all be prepared for whichever way it goes, some increases are likely to happen. And we should be anticipating that and making decisions on that rather than sort of thinking, well, let's see what happens. Very quickly, why they're doing this, why they're kind of increasing the rates, it all comes down to inflation. And the current predictions from the Bank of England on where inflation is going is actually that we might already have seen the peak of inflation. It was 11.1% in October of this year, around 11%. And that may well have been the peak. The most recent figures are down slightly from that, 10.7% for November 2022, based on the previous 12 months. And they think actually we're going to see a gradual sort of decline going down again. And that's partly why the rates maybe won't go up as high as I expected, but they're still going to be high. It's not sudden that prices aren't going to suddenly drop back down. They're still going to keep increasing. Inflation will still continue, but it will start dropping down from that peak of 11%. This is the current prediction anyway. But it still might be a while before it gets down to the target rate of 2%. That could be another 2 years away, if not 3 years away, before it goes there and maybe below that 2% target. So things are still going to be getting more expensive, and hence that's why they want to put interest rates up, because hopefully that will encourage people to spend less, and then prices will come down as a result. Although, again, I'm not an economist, but obviously I'm sure you're aware of this already, but a lot of the inflation happening right now is due to not just domestic issues, but those international things such as the war in Ukraine and what impact that has had. But there are lots of other things that have had an impact. So that's what's happened. The next meeting will take place on the 2nd of February, 2022. And that is when we'll find out what's going on there. And obviously I'll give you an update on the channel. But let's talk about what's happening for your savings and your mortgages right now. So we'll kick off with mortgages actually, because that's quite interesting. When I've done these other updates throughout the year, one of the main things I've said to you is that if you have currently got a variable rate mortgage, then you want to get on a fix, because variable rate mortgages are always and have been the most expensive mortgages out there. And if you're on one right now, that rate is already going to change up. Almost, I'm pretty sure every single mortgage lender, they will put on that extra 0.5 percentage point onto your mortgage. They might not do it immediately, but they probably will do some kind of increase very, very soon. So that mortgage will get more expensive straight away. Moving to a fix would hopefully protect you from future increases. What's happening right now, what's interesting though, is that fixes are starting to come down after that kind of flurry of deals being pulled from the market after that mini budget a few months ago, and rates going up as well. They were brought back in, they were much, much higher. They're starting to come down a bit. And this is where it gets slightly more complicated, because I would suggest that you talk to a mortgage broker. If you are on a variable rate mortgage right now, or if you are potentially on a fix that's going to end and you're worried about what's going to happen later on, just to kind of get a sense, because they will know the market better than anyone else. There's no crystal balls. They can't say exactly what's going to happen, but they will give an idea of like, actually, you might want to hold off a bit. Maybe fixes will come down more based on what's happened today. Or it might be that it doesn't make much of a difference. One of the things you will get if you do decide to fix right now, rather than waiting to see what happens, is at least you'll get that certainty against potential those increases we like to see in 2023 coming along. So I would actually have a talk to someone. If you want a variable rate mortgage, have a chat to someone. If you want a tracker rate mortgage, then your interest you'll be paying will automatically shoot up as of today. A tracker rate is a set rate which follows the base rate. So that's now going to be an extra 0.5 percentage points higher. And that's going to add on a fair bit of money. Considering that over the last year, that increase of 3.4% in the last year will be added onto your monthly payments. You will see it every month it comes out how much more you are paying. Now, again, that you might want to think, if it's going to go on another percent on top of that, it could be 4 point something next year. Maybe I want to get out of my tracker right now. Maybe I want to go onto a fix. Again, have a conversation. You might find that actually trackers are still cheaper right now than the fixes, and you'll be saving some money at the moment on your mortgage, which actually will then, if it does go higher because the interest rates go up versus a fix next time, it might even out. It's really hard to say. So get some advice on this. What you have to remember though, if you're on a fix right now, nothing will happen. Nothing will change at all. But when that does come to an end, then you will be looking at probably some increased rates, because again, rates still going higher. And it's important to say as well, although we're looking at fixes potentially coming down after their sort of little jump up, it doesn't mean they're going to drop back down to where they were, those really, really low rates that we were getting 15, 16 months ago. So that's mortgages. Have a think about what your situation is. See if you are able to get onto a new deal, if it's good for you. If you are tied into something already, you've got early redemption charges probably come into play, where it's difficult to cancel without paying a charge. It might not be worth doing it again, but that's something you can discuss with a mortgage advisor. Let's talk about savings now then. So one of the things that we are likely to see as a result of this increase, not immediately, right? That's why I say every single time this happens, don't expect suddenly all your savings accounts suddenly to be up another 0.5% higher. But we will see some accounts move their rates up. And they probably won't be the full amount, it'll be a partial amount. No one ever really puts on the full amount. We didn't see all these accounts suddenly jump up by 0.75 percentage points 6 weeks ago. In that time, they haven't, but some have moved up and some have improved. So we'd like to see that again. But where we're likely to see that will be in the easy access accounts, maybe some limited access accounts, ones where you can get your money out, 6 times a year, twice a year, whatever it is. And in regular savers. Now, we've seen some really big movements in regular savers recently. That First Direct paying 7%, Club Lloyd's 5.25%, others around that kind of mark. Maybe a few others might jump up there. Maybe we'll see some other ones boost up to 6, a bit more competition in there. And maybe we'll see in the easy access accounts. Right now, the best you can get 2.9% from Chip. It's a bit of a weird account, but they've said that if the base rate increases, they may increase it. So by the time this video goes out or the next few days, maybe they would have boosted that even more, and maybe others will react. So there will be some movement, likely some movement to happen there. So that's great for your money you need to keep available to you. What we're unlikely to see is much of an increase in the fixed rates. And in fact, over the last 6 weeks or so, those fixed rate savings accounts, the offering they've been giving you has been dropping. They may well have peaked. So for a 1 year fix, it got to about 4.65 and now sitting at 4.32. And similarly, you could get 5 year fixes above 5%. That's now around 4.8. The reason these have been dropping, even though base rates have been increasing, is because there was an expectation, as I mentioned before, that the base rate could go up to 5.5% or even 6% next year. So the fixes, which are anticipating rates over the longer term, they went up up because of that. But then with this revision, now if we're looking at 4.25%, 4.5%, maybe 4.75% next year, well, that's kind of what they're pricing in right now. And it may well be that we see, like, even with this increase now, doesn't make a difference. They've priced that in. So fixes may stay where they are. They might already have peaked. They might even drop down even further. So it's certainly worth considering. If there's money you do not need access to, that you can afford to lock away, to take advantage of these rates, because chances are they won't go up. There is the risk they will. Of course, you might find one provider wants to put something up over here, another one wants to do something over there, and there might be a bit of competition going on to try and get some money, even if it's short-lived. So there is a risk if you do that, you'll miss out. But the flip side of that is there's a risk if you don't fix, then they'll drop even further. Again, no crystal balls, can't guarantee any of this, but that's certainly what things look like. But there are things, and I'll do an update, probably savings video this weekend, if there have been any quick changes. But also there is a new ISA from Barclays paying 4%. It's fixed for a year. 4%, that's fantastic. And it is an ISA. So that is head and shoulders above all the rest. So you never know. There might be a few other things happening. There's never a guarantee. I think that's probably everything to talk about for this particular update. Just to cover everything quickly again, looking like inflation has hopefully peaked, but it's still going to remain high. Prices will still continue to be going up over the next year compared to the year previously, but just maybe a slightly lower rate. And because of that, interest rates are still likely to increase next year, but not as much as was expected. But just remember, factor that into your mortgages, your savings, any other borrowing, because that could well have the impact. My name is Andy Webb. Thank you so much for watching. If you found this video useful, please do hit that like button and leave me a comment. It makes a big, big difference in helping the channel grow. And in the meantime, check out these videos here for more on your finances.